to convert older passenger jets into freighters, and these are going to start to come online mid-decade, right around the point that the passenger jets will be flying again, and Airbus first, and then we think a couple of years later, Boeing will have their new jets out.
And then we'll have a glut, right? So supply demand, there it is at work.
All right, better start adding windows to the cargo planes and getting the passengers' seats back in there.
Exactly, right? I mean, is this just a temporary problem because of the supply chain woes or what?
No, they think this is a fundamental shift.
Okay.
That the market, shipping is always going to be there and it's always going to dominate. But with e-commerce, you're seeing, what used to, this whole, what was described to me as fragmentation. So instead of the ships coming in these steady waves that you could, set your watch by from China so that the goods would be on the shelves for Halloween and Christmas, we're seeing more and more of that move to pallets in cargo ships and then also into packages that also travel by air and maybe in smaller airplanes, for Amazon and its counterparts. So I post-COVID, I don't think that trend is reversing. So there is going to be demand, but there's just a crazy amount of supply being created to meet that demand.
Okay, there's supply, there's demand, and then there's just good old-fashioned rivalries. And like Boeing, Airbus, that is like one of the best ones. Who's got the upper hand in the rivalry, at least in this chapter of it?
Boeing. This is Boeing's world. I mean, so about 90% of the world's air cargo right now travels on Boeing or McDonnell Douglas, which Boeing bought, jets. And I think Airbus has woken up to the fact that Boeing this year has been selling a lot of freighters. Airbus really doesn't have anything in the market, and so they're going to try and crack, yet another part of the market that Boeing has dominated.
What makes it more efficient for a company to buy a brand new freighter versus convert one that was a passenger plane into a freighter? Like, because there are more efficiencies when it comes to fuel and weight and stuff, but what's the calculation there?
No, that's a great question. So part of it depends on what you're shipping, and the factory freighters are stronger. They're reinforced. They're built specifically to carry heavier loads. So that's one advantage. And another big one is reliability. I mean, if you have to get it overnight, you don't want a plane breaking down and just, totally just leaving your customers fuming.
Well, and I do wonder what the play is, Julie, here. Is it, the planes from Airbus and Boeing, the brand new ones, or I love this line in your story that talks about, I guess, a big jet, a 777, a 777-300ER could cost upwards of $150 million new a decade ago. Now you can pick it up for a mere $20 million. Sounds like a bargain, and then you retrofit it. So is it those who are leasing old planes that are kind of the investment play here potentially?
Yeah, well, we could go on, but part of the issue is that Boeing and Airbus kind of got greedy a decade ago and pumped just an enormous number of these huge wide bodies out into the market. And so that market is glutted, prices have collapsed, and really new
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading on this Wednesday, November 10th, and we have got the Dow, the S&P, and NASDAQ all declining right now. We're close to session lows. Slight bounce off the bottom, but still red on the screen. Right to the numbers. We'll give you the why in a moment here. S&P down 47, lower by 1%. NASDAQ down 312, dropping almost 2% now. The Dow is down 268, lower by 0.7%. Stocks falling by the most in a month. Treasury yield spiking higher as that hot inflation reading this morning roiled financial markets. S&P 500 index lower by 1%. 10-year yield right now 1.55%. 10-years down 31/32. Spot gold up 0.9%. 18.47 the ounce. West Texas Intermediate crude tumbling 3.6%. 81.12 a barrel. And Bitcoin down now by 1.8%. Earlier touched a record. Bitcoin right now 66,485. Just about 1 hour away from the latest numbers out of the Walt Disney Company for Disney investors. The focus will be on streaming subscriber growth at Disney Plus. Michael Nathanson is founding partner at MoffettNathanson.
There is so much great content available that the only way you get subs at this point is by spending more money on content, building awareness, trying to have a breakthrough hit. Disney's done a great job getting to this level, but in order to grow further, they need a lot more content. They have to have that flywheel spinning faster than they've done so far.
And right now we do have Disney shares lower ahead of the earnings report, down by 0.5%. First day of trading for Rivian Automotive. That's the electric truck maker. Rivian shares up now by 26.9%. Recapping, stocks are trading lower with the S&P down 46, lower now by 1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, everybody. Yep, this is the Wednesday edition of Bloomberg Business Week. Carol Masser along with Tim Stenovic in our Interactive Brokers studio. This comes up in a headline. Howard Marks of Oak Tree Capital Management talking about the markets. We know we want to know more.
Yeah, wait a second. I thought we were at record highs, or at least until, yesterday we were, and just record closes day after day. But still, he's saying put your bonus in an S&P 500 fund and just close your eyes.
Yeah, it's kind of worked for a long time, it feels like. Bloomberg News personal finance reporter actually caught up with Howard Marks. She is Suzanne Woolley, and she joins us here in our Interactive Brokers studio. Howard Marks, this is someone who's seen a lot of market cycles and someone very familiar to our audience.
Yes, and he's made really good calls on a lot of market cycles. And his view is just, most investors, we've heard this before, most investors should not his feeling is we don't do our own dental work, we don't even fix our own cars, Investors shouldn't necessarily think that they can time the markets and,
And neither can those they're looking at a younger generation, whether it's how they shop or how they do fintech, and they're listening up.
It's true. I hear them from financial planners who have their clients call up and say, my son made 4,000% on this meme stock. What am I doing?
What's this Doge that we talk about? Dogecoin. So it's interesting. What about private equity? And this is something that increasingly you're hearing the private equity world wanting to be able to tap to a wider audience, right? And I think it's safe to say that some individual investors, accredited or other, who would like to have a piece of private equity and the returns.
He thinks that alternative investments will ultimately find their way into 401ks, which they largely are not now.
Right.
But all the money that's pouring into private equity, he was talking about pension funds and endowments, they need to get sort of a 7% return to make the math work. And they can't get that. in the stock and bond markets.
Yeah.
So they basically have to turn to alternatives, and the biggest category is private equity, so that's where the money's going. His concern is having so much money, chasing deals doesn't lead to great returns.
When I read something like that, though, I think, okay, wait a second. The S&P 500 right now is up 23% this year. So had he just set it and forget it in an S&P 500 index fund, then they would have certainly seen, those endowments would have certainly seen more than a 7% return this year.
That is a really good point.
I don't know.
Exactly. And you do wonder, do we get a little bit of a rethink from endowments? And I
Yeah.
guess we'll only see, time will tell. It's hard, though. They're very entrenched in alternative assets.
And they need sustainable returns. I mean, they need dependable returns. And it's going to be interesting to see if private equity will produce what they need.
They need 7% in years where the S&P 500 might be down 10%.
Exactly.
Yeah.
Suzanne, what was your biggest takeaway from talking with Howard Marks? I mean, I love what I consider like sages of the financial community. We're somebody who's seen a lot of different cycles, seen crises, and can kind of look back like a Warren Buffett, right? And doesn't necessarily stress out too much, but looks for opportunities. What was your biggest takeaway?
This is really basic, but what stuck with me is how holding is the key. Because I think we're all so much more interested in the markets now. We have so many more ways to tweak our 401ks and, go on Robinhood and this and that. And the key is, your asset allocation and holding, not jumping in and out. So just the simple fact that we have to remember not to try to time the market, that boring investing can be really good investing.
We hear it from people like Warren Buffett all the time too.
It's not sexy, but it's true.
Yeah, exactly. No, it's interesting. Although, I'll sometimes argue that there is a point when you look at a year like this year or last year where you could say, all right, 20% or something, or 15% or 70%, that's a great market year. Let me play it safe. Let me move it to the side. Because we do get corrections, or even if we don't get an official 10% correction, we get awfully close, right? So yeah. I understand this time in the market, but you've done this long enough, I've done it, where I'm like, I can see where we're a little overheated, and you're going to see a bit of a pullback, right?
I know. I think, the reason that comment stuck with me is because, I am looking at my 401k and I'm dying to take money off the table, basically.
Suzanne's buying an island in the Caribbean. No, but right?
Yes.
You just get to a point where you're like, and they've always said, don't be too greedy when
Right.
you're looking to sell something. Have your your exit point and be comfortable with it.
But that would be breaking the cardinal rule, right? Which is just use it when you need it, when you retire, and take out 4 to 6% a year.
Yeah.
You're the personal finance
basically.
reporter.
No, you said it well.
Is that? Yeah, but it's hard. It's hard to resist that temptation when you see the S&P 500 higher by almost 25% in a year.
It is, and that's. I feel it. We all feel it because portfolios. 401ks are looking pretty good right now, but.
Right, who knows?
That could go away.
Hashtag FOMO, hashtag Tina. Let's just do the whole hashtag.
Hindsight bias. There's a whole psychology thing here we could be talking about too, right?
Always good to hear what you are writing about, and always great to hear what Howard Marks is up to. So thank you so much for bringing it to us. Bloomberg News personal finance reporter Suzanne Woolley. You can check her out at Bloomberg.com and on the Bloomberg terminal.
Let's get to check the latest world and national news. Nancy Lyons is in D.C. Hey, Nance.
Thanks, Tim. President Biden is expressing concerns about inflation, saying in a statement it is a top priority and he believes the price hikes are being fueled by rising energy costs. He says his administration is working to reduce those costs. The consumer price index rose by 0.9% in October, and the year-over-year jump was the highest in over 30 years. Well, the president believes the bipartisan infrastructure bill will help relieve pressure on supply chains. One reason that's been given for those rising prices, Bloomberg's Anne-Marie Hordern says he'll be promoting the $1 trillion deal at the Port of Baltimore this afternoon.
He's really taking a cue from what he learned as vice president from the Obama administration. Obama didn't go around the country talking about the Affordable Care Act after that was passed in 2010, also the stimulus in 2009. And Biden thinks that was likely a mistake.
Bloomberg's Anne-Marie Hordern says he'll also likely press for his human infrastructure agenda. Emotional testimony today from Kyle Rittenhouse, who's standing trial in the murder of 2 protesters in Wisconsin. He broke down on the stand when describing how he felt trapped.
I was cornered from in front of me with Mr. Zeminski, and there were There were 3 people right there.
Rittenhouse claims that he was only acting in self-defense. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. So from one well-known investor to another we go.
From one well-known investor to the
Once upon a
wealthiest person in the
time.
world.
Are you talking about? Who are you talking about?
I'm talking about Ken Griffin, Citadel's Ken Griffin, and Elon Musk.
Oh, yeah. All right, so, man, I love these billionaire on billionaire stories.
Well, so I'll get to the story and I'll say that I actually had kind of a similar reaction here. So Citadel's Ken Griffin said he was shocked that fellow billionaire Elon Musk polled social media users about whether to sell 10% of his stake in Tesla. So on Wednesday, the hedge fund manager told the New York Times Dealbook Conference, quote, "I never thought we'd let our ownership stakes be dictated by a poll on Twitter. We live in a whole different world."
Well, we really do, though, right? I mean, think about crypto and everybody laughing ha, 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 a few years ago. And now you have much more legitimate firms all talking about the use of it.
Okay, but I can't get into
Which
Elon
part?
Musk's head, okay? I can't get in there. And I know we all
Which is
tried
why
to
you
get
are
in
not
there.
at one point, a billionaire, and you're not
Billionaire 300 times over?
you're not creating holes in the ground and sending people to space.
Yeah, all right.
All right, hard.
Easy, Nasser, okay? I think you're right.
No, it blows my mind in terms of his ability to tap social media for what I would say as the head of a company holding stock. Like, are regulators okay with that?
Okay, but
although it's fully transparent,
we have to remember that Tesla spends approximately $0 a year on marketing.
Because
and
every day
Elon
you and I
Musk-
talk about Tesla.
Exactly, because Elon Musk is so good at becoming the zeitgeist. He's so good at getting in the news cycle. And I think, look, he knew exactly what he was doing when this poll came out. And like we talked to Dan Hole about earlier this week, he spoke at the Recode conference earlier this year, said he was going to sell stock.
If you're worried about Griffin and Musk fighting, though, Griffin, for his part, said he liked to see companies controlled by their founders and that he doesn't want tax policy to drive, quote, great entrepreneurs like Musk out of their roles. So,
sometimes you got to pay taxes, though.
That's what the IRS tells me.
Sometimes you have to sell stock in order to pay those taxes.
But it is interesting, this use of social media. This is the world, the environment that we are living in. All right, you're listening to Bloomberg Business Week. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters. I'm Charlie Pellet. Rivian rallies, stock slump. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are under pressure today, helped by a hot CPI number, and which showed their fastest annual inflation rate since 1990. Dow's currently down 213 points. S&P's dropped 38. NASDAQ is lower by 266. The U.S. 10-year yield jumps to 1.55%. Gold is up 15. Oil is under pressure. And among the main 11 S&P sectors, only utilities, staples, and healthcare were in the green. Leaders to the upside in the Dow, Amgen and Procter & Gamble, while Salesforce, Nike, and Goldman Sachs led to the downside. You mentioned Rivian. It opened at 106.75. The IPO was priced at 78. And in U.S. politics, Joe Manchin said the threat posed by record inflation is not transitory. Wrapping things up, a firm holdings Bumble and Disney report after the bell. Live from the first breaking news desk on Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg type Squawk SQUAWK on your terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
So, thank you so much, Charlie Pellet. We had to wait hours for it to begin trading. It is this year's biggest initial public offering, at least so far. It will be the 6th largest ever on a U.S. exchange, according to Bloomberg data. We are talking about Rivian.
Yeah, shares higher by more than 30% right now. The company IPO'd at $78 a share. Ed Ludlow is West Coast correspondent. He has been following the Rivian story for years. He joins us live now from our San Francisco bureau. Ed, 32% higher, valuation of about $100 billion, plus or minus a few billion here or there for a company that barely has any revenue.
Yeah, I mean, it's really interesting, right? Because no matter where the shares really landed, this was going to be one of the biggest publicly traded automakers in the world. You know, there are some really big names out there from Japan to Europe that have done this for a long time, built millions of vehicles, and Rivian makes them look teeny tiny. And, you know, the shares have kind of bounced around. We're about $102 a share. At one point, we were at $119 a share. You know, the market cap's been moving. The fully diluted valuation's been moving. But there's been great appetite for this stock in this IPO from institutional investors and retail investors as well.
All right, so Ed Ludlow, you follow this market so well. Market cap now of almost $88 billion on this company. I think it's more than Ford. I think it's more than General Motors. So is Rivian, there's a lot of investor interest. We had, JP Morgan, Morgan Stanley, we had Goldman, lead underwriters, more than 20 underwriters. There was so much investor interest. Is this an investment play, or is this a company for the long run?
It's a company for the long run. I mean, they're early in their life as a genuine maker of electric vehicles. They've built less than 200 battery electric pickups so far. Most of those have gone to employees. They haven't even started going to customers yet. They might build 1,200 vehicles by the end of the year, and it's a really slow ramp. It's going to take them until the end of 2023 to hit annual production of 150,000 EVs. You know, if you compare that, Tesla's on course to do 1 million this year, right? But so much of its valuation is tied to what it's achieved to date on the financing side. $10.5 billion in the private markets, big names. Amazon is an investor, but Amazon has also ordered 100,000 battery electric delivery vans from Rivian. And according to sources, that is a really big factor when it comes to the valuation going into this listing.
Talk about having a nice safety net. It's almost like, you know, being a government contractor, right? And getting a government contract to know that going in. Having said that, when we think about the Rivian story, can we liken it to the Tesla story in terms of it took a while for Tesla to ramp up and be profitable?
It took an awfully long time. You know, Bloomberg's reported that one of the characteristics of Rivian as a company and RJ Scaringe as a CEO is the care, the deliberately slow pace they've taken, the prudence. You know, according to sources, RJ Scaringe basically looked at the mistakes that Tesla had made, looked at what legacy auto had done to electrify and said, we don't want to do it that way. He founded this company in 2009. They didn't unveil the pickup truck in 2018. And 3 years later, they're doing modest production. It's been a very deliberate and very slow ramp up to where we are today. But that's been carefully calculated, I'm told.
How big of a deal is this Amazon investment and Amazon order? I mean, would Rivian be where it is right now without Amazon?
It's absolutely key. You know, according to sources, you know, on one hand, the valuation reflects Amazon as an investor, right? They pumped a lot of money. They have 20% ownership interest. That gives you credibility. When the world's e-commerce giant gets behind you, you have Jeff Bezos talking about you. You know, that says, okay, these guys are legit, even if they haven't produced much. On the other hand, that order for 100,000 vans, analysts have estimated it's about $5 billion of revenue. And that's just a single order from one company. Amazon has exclusive rights initially for 4 years, but Rivian plans to sell to others. And they see that commercial EV business as a point of differentiation when others are kind of more focused on consumer EVs.
Okay, so Ed, I'm also seeing in my own head interest just from the idea that people perhaps see this as another Tesla story, and they say to themselves, well, if I got in on Tesla at the IPO, I'd be one of those Teslanaires that Dana Hull, our colleague, writes about. How much of Tesla, the Tesla story, is baked into this?
It's very interesting because when they unveiled the pickup on stage, that is what the world had been calling for, or at least North America had been calling for. Americans don't drive little sleek sedans, but at the time, that's what Tesla was offering in the Model 3 and the Model S. Now it has the Model Y and the Cybertrucks come later. But people want these big, bulky vehicles. So they buy into that story because it reflects what the modern day consumer is looking for in a vehicle, regardless of its drivetrain. I thought it was really interesting that Rivian offered 7% of the shares to early customers, people that had pre-orders for the pickup. Because think about the relationship Elon Musk holds with his customers. You know, many of those Tesla customers also own the stock, and it seems like Rivian was kind of key to that idea. They also offered 0.4% to retail traders through SoFi. You know, they're kind of conscious that there are people that invest in this because they believe in the narrative around the transition to electric vehicles or sustainable energy more broadly.
People like their trucks too. I heard you talking with Matt Miller over on TV earlier.
All day I've been, yeah. That guy.
That guy who also loves his trucks. But I mean, trucks are usually a high margin business. I mean, and America still loves their trucks, right?
There is a worry here, which is Ford's coming with a battery electric truck, GM, those will be much cheaper than Rivian's, which is 70,000. After you get beyond the 70,000 mark, that addressable market shrinks. And there's a worry from some section of Wall Street that Rivian's addressable market in that category has a ceiling of around 300,000 to 400,000 units a year.
What does this puppy cost?
The R1T.
No, but what does it cost?
The pickup, R1T.
How much? How much does it cost?
$70,000. I'm getting tired. I'm getting older in the course of just a day, Caroline.
You are doing just fine. Ed Ludlow on Rivian. This is Bloomberg.
Bitcoin now lower by 1.1%, retreating from a record 66,979 on Bitcoin. New York City is seeing greater than expected demand for vaccines for children between the ages of 5 and 11. Dr. Bhakti Hansadi is Associate Professor of Emergency Medicine at the Johns Hopkins Bloomberg School of Public Health.
This has been a great week, and let's not be Debbie Downers. Hundreds and thousands of children are about to get vaccinated. Those children who are the youngest are in school, least likely to tolerate masks. So I think we are going to get there, but it takes time, right? Children need 2 doses, and then after 2 doses and 2 weeks after that is when you fully are able to say you're immunized.
Dr. Bhakti Hansadi with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks that we follow, Pfizer up now by 3.4%. ADRs of its German partner BioNTech up by 4%. AstraZeneca's ADR is up 0.6%. Moderna out of Cambridge, Massachusetts, down 3.7%. Johnson & Johnson up by 1%. Among the names reporting after the closing bell, the Walt Disney Company. Disney shares little changed right now, up by less than 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. This is Bloomberg. All right. Dave, I feel like you're getting into my era here, okay? Semi-charm kind of life. Is this Matchbox 20?
Nope.
Oh.
Blind? No.
Blind.
Blind Eye.
Oh, Third Eye Blind.
Third Eye
There
Blind.
you go.
Oh, but it's Semi-charm kind of life, right? That's the name of the song?
Well, the song doesn't have the kind of in the title.
Semi-charm life.
Close enough.
Wow, I can't even get stuff from my own childhood, right?
Come on.
You should see the look.
You
Carol's
know, I got so, distressed with Katie Greifeld yesterday.
What happened?
She had no clue. So it's like, okay,
We
she's
love
telling
Katie,
me
though.
what she likes.
Okay.
So was that for Katie? Was that for Katie?
That was for Katie.
Aw, Katie Greifeld, if you're
okay.
out
And I
there.
figured you would get it too, Tim. So, it's all good.
Well,
Although-
we'll send her a tweet, then she'll hear it.
Sounds like Katie would have been done better than this one.
Yeah, wow. I gotta give myself a D.
Little shade to you.
That's okay. I
All right.
deserve it.
Yeah.
In any case, if you
So what's the title of the song? How do we,
Semi-Charmed Life.
Okay, so to the chart.
Yeah, I mean, if you own anything other than the S&P 500 and you're a stock investor, you probably feel semi-charmed about now. I mean, given valuation.
Just talked about this with Suzanne Woolley and Howard Marks, right, buying the
Yeah.
index. Anyway, go ahead. please.
Absolutely. I mean, but this is the flip side of the coin, and it's
Okay.
Jim Paulson over at the Luthold Group, their chief investment strategist. And what he did, I mean, it was an interesting sort of way to kind of do a back-of-the-envelope calculation. He took the S&P Mid-Cap 400 index, the S&P Small Cap 600, and then an MSCI index that tracks developed and emerging markets other than the U.S., averaged out their price-earnings ratios based on current year profit estimates, and then compared it with the S&P 500. And when you do that comparison, you find out that lately, last couple of weeks, all those smaller, mid-size international stocks discount as much as 25% relative to the S&P 500, and that's the biggest since at least 2005 when our data gets started. So, that really
It's
kind
only
of
cheap
jumped
if they
out.
deliver ultimately in the long term.
Well, but that's true. But when you look at the chart, I mean, you have seen a heck of a swing. Last year, they were more expensive by something like 25, 30%, and now they're cheaper by pretty much the same amount. So the pendulum has really swung here.
Dave, does this have anything to do with the makeup of the S&P 500 and a handful of heavyweights accounting for such a large portion of it?
It has everything to do with that because those kinds of shares have been leading the way, and you don't have quite the industry makeup of the smaller company indexes or, the non-U.S. stocks that you see with the S&P 500 and the likes of Apple and Microsoft and all the rest.
Hello, $2 trillion market cap Alphabet.
Yeah, let's see. Is it $2 trillion
Well, it
as
was.
we speak?
It
Not
was.
at the moment.
It passed it.
It was there,
Yeah.
but the shares are down more than 2% today, both classes in the S&P 500. So It's backed off $2 trillion. Nonetheless, I mean, that goes a long way to explain the comparison. So if you want to know more, folks, send me an email. I'll get you the chart, the explanation that goes with it, and everything I do going forward. The email address is dwilson@bloomberg.net. That's dwilson@bloomberg.net.
Go ahead, Carol.
No, where are you going?
I just want to know what yesterday's song was that Katie got so wrong.
Kansas.
Point of no return.
Okay. I wouldn't have gotten it either.
But he gave a hint of Dust in the Wind, because everybody knows that from.
Yep.
And it's on the same album.
Yeah, see? Okay. Stock of the day?
Ring Central, the ticker RNG. We're talking internet-based communications software. Company was out with results late yesterday, and suffice it to say they went over pretty well. Third quarter earnings and revenue beating analyst average estimate in Bloomberg survey. Same with fourth quarter forecast. Oh, and by the way, they're expanding by agreeing to buy patents and what they call intellectual property rights from Mitel, Canadian company. We're talking network and call management, security, and infrastructure. It's a $650 million deal. You know, put it all together, and it's gone over pretty well. I mean, you're talking about a stock, again, RNG for Ring Central up 20.5% as we speak, headed for its biggest gain in more than 2 years.
But kind of down a bunch from its high earlier this year, and it's down on the year. So it's getting a nice big kick. I mean, you look at the chart, right, and it's been not so great, and then it's
down about 26% for the year, so definite recovery today.
Be sure to check out Dave's Stock of the Day. It's just after 4:15 p.m. Wall Street time on Facebook, LinkedIn, and on Twitter at The One Dave. All right, I won't get the third eye blind thing again tomorrow. I know, won't get it wrong again. I know.
All right, let's get to world and national news. I bet Nancy knew it. Nancy, did you know that song?
I knew that. I knew Third Eye Blind. I couldn't type it. I couldn't type it fast enough. Sorry.
Okay, take it away.
Anyway, President Biden is using the Port of Baltimore as a backdrop this afternoon to tout the infrastructure improvements that will flow from the bill just passed. Bloomberg's Irv Chapman reports among the beneficiaries will be the nation's antiquated railroad facilities.
In addition to expansion and improvement elsewhere in the country, Amtrak will have $24 billion to spend on the most traveled route between Boston, New York, and Washington, Chief Executive Bill Flynn said in a Bloomberg interview, where trains rattle over 19th century tracks.
The Baltimore-Potomac Tunnel in Baltimore started service in 1873, and Grant was president. We've got bridges in New Jersey, then the Hudson River Tunnel, several more tunnels, 120 years old.
Work will start first on a bridge in northern New Jersey, but the long-awaited replacement for the tunnels under the Hudson River to New York Penn Station, Flynn said, won't be completed until 15 years from now. In Washington, Irv Chapman, Bloomberg Radio.
Kyle Rittenhouse says he was forced to shoot during a deadly social justice protest in Wisconsin. The 18-year-old is accused of opening fire on protesters, killing 2 men. Rittenhouse was questioned first by his defense attorney, Mark Richards, today.
People were saying, cranium him, get him, kill him. People were screaming, and I just was trying to get to the police running down Sheridan Road.
And you say I'm trying to get to the police. Why were you trying to get to the police?
I didn't do anything wrong. I defended myself.
During cross-examination, prosecutor Thomas Binger asked Rittenhouse whether it was appropriate to use deadly force to protect property. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. So a story we want to mention, bring to your attention, has to do with a McKinsey & Company partner who advised Goldman Sachs on its impending acquisition of Green Sky, was charged with using inside information about the deal to make more than $450,000 from illegal trades. I have to say, in this day and age where so much can be tracked, there are records of everything and a digital trail. It's interesting.
Well, there's a lot of mentions in the story about the digital trail and what this partner who has been charged was allegedly doing. Puneet Dikshit, 40, bought short-term, Green Sky options before the bank's September 15th announcement that it planned to acquire the financial technology company for around $2.24 billion and then sold them when shares soared on news of the deal. That's according to criminal charges that were unsealed Wednesday in Manhattan federal court.
Also facing a suit by the SEC, which alleged that he reaped a 1,829% return on his $647 trade. He allegedly made some of the trades from his work computer. McKinsey said today, McKinsey said today that it's actually fired him for, quote, a gross violation of its policies and code of conduct. Here's the quote from them. "We have zero tolerance for the appalling behavior described in the complaint. We will continue cooperating with the authorities, they put that out in a statement. And apparently his lawyers, Dixit, didn't immediately respond to email messages.
Yeah, so I mentioned that the tracking that takes place on computers and how there is a digital trail left behind. According to the SEC, evidence of Dixit's insider trading was found on his work computer. Prosecutors said on the day before the Green Sky deal was announced, he allegedly used Google to search what happens to options when company is acquired and, quote, Green Sky market cap. He also used it to check his broker's webpage for information about $10 Green Sky call options, according to prosecutors.
What's fascinating about this story, as you said, the digital trail, and it also talks about a CNBC report, like a media, there's just so much that was going on that was able to be documented. Again, allegations, but nonetheless, there's a lot of information out there. This is Bloomberg.
Treasury yields spiking higher as that inflation reading this morning roiled financial markets. S&P down 40 now, a drop of 0.9%. 10-year yield 1.55%. We've got the Dow down 236, down 0.7%. The Nasdaq Composite Index down 273, a drop of 1.7%. Nasdaq 100 Index down 1.5%. The Russell 2000 down 1.6%. Bitcoin retreating now by 2% after hitting a record earlier. Right now, Bitcoin 66,364. Spot gold up 1%, 18.49 the ounce. West Texas Intermediate crude down 3.5%, 81.23 for a barrel of WTI. First day out for Rivian Automotive, making its debut to date. The electric truck maker pushing higher now. Rivian up by 28.4%. Among the names reporting after the closing bell today, the Walt Disney Company, its shares now lower by 0.1%. Recapping, S&P down 40, down 9/10. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
After weeks of decline, the number of COVID-19 cases in the U.S. has stalled at roughly 70,000 per day. One reason for this stubborn persistence? Fewer than 60% of Americans are fully vaccinated. That's why President Joe Biden is right to stand by his vaccine mandates for federal workers and large private businesses. Opponents call these requirements a threat to individual liberty. This criticism is misguided. Immunization requirements are nothing new in America, and they've already proven effective in boosting vaccination rates. It's true they're an imposition on personal freedom, but so are speed limits. The point is, they're justified. Public health requires that people refrain from needlessly harming others. As long as the unvaccinated population remains large, the virus will continue circulating. That means more Americans need to get their shots. Vaccine mandates will help make it happen. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just about 10 and a half minutes left until we wrap up the Wednesday trading session, and it's definitely been some volatility. We were in a much more bullish position a little bit earlier in the day, but then we headed to our lows just after about 2 o'clock Wall Street time, bouncing off of it, but staying near it, and we were definitely seeing pressure on the equity trade. Let's get to it with Anu Gagar. She is Global Investment Strategist for Commonwealth Financial Network, back with us on the phone from Waltham, Massachusetts. Anu, nice to be talking with you again. Tim and myself kind of watching the trade here. We're talking a lot about inflation. How do you see the market worries playing out today? What's really kind of pushing the equity markets? Let's start there, down today, in your view.
Carol, nice to be back here on what seems to be a red day for the most part. So what you see in the markets today is really a reaction to the hard CPI print from this morning. Inflation soared last month. No matter how you look at it or slice and dice it, CPI print for October was well above consensus expectations and highest since 1990. And the increase was really broad-based, with all the individual components rising during the month. So in terms of what you saw in the market, the 10-year yield is higher in reaction to the strong CPI number. But the real action is in the front end of the curve, which has moved up much more significantly, probably because investors are pricing in possible Fed action earlier than currently broadcasted.
When do you think what are you seeing in the curve? Like, when do you think investors are expecting Fed action in terms of raising interest rates?
Well, that's an interesting question. And what I'm really watching is the December FOMC meeting, where I'd really be looking for movement in the dot plot to see if the first rate hike is pulled forward, and also the tapering of asset purchases is expedited. Because the Fed did mention at its last meeting that they could adjust the asset purchase pace depending on the economic outlook.
So, it is interesting. Our Ira Jersey was so smart early, or market think that's going to maybe stay with us a little bit longer.
Yeah, in fact, you make a great point because the Treasury yields or the 10-year yields, they have been quite peculiar because the decline in the 10-year yield in the last several days, before today, of course, it caught several investors off guard. Because after rebounding from the summer lows, the upside momentum in the yields fizzled out and quickly started to reverse, even as inflation data continued to run hot. And papers started to show up on the horizon. But today we got more prints on the inflation, and it seems like we're looking at more persistent than transitory inflation. Now, there are transitory elements to the inflation, ones that relate to the supply side disruption. And we could see that ease as the supply chains are cranked up. So some of these acute inflationary pressures could deflate in the latter half of 2022. In fact, we could also see some opposing forces at work, as is usually the case with such cycles, when too much capacity is built up in anticipation of sustained elevated demand. But then there are stickier components to inflation. Labor force participation rate, it's hard to raise that, as the ones that chose to retire last year, they may not re-enter the workforce, which means that we'll finally see wage growth, which was really hard to generate in the last cycle. And then rents and shelter costs are rising as the housing market remains tight. And these are the stickier components of inflation and could result in more persistent inflation.
What's a realistic expectation for when you think we'll start to see inflation go down, if it is indeed transitory?
Yeah, so I think the second half of 2022, we could start to see these, the more transitory components of the inflation, which were related to the reopening of the economy or the supply chain disruptions, et cetera. So those could start easing a little bit in the second half of 2022. But the real thing that I would be watching for is the rents and housing costs or owner's equivalent rent, because that is really a third of the CPI number. And rents generally have a 12 to 18 month lag with housing prices. And we've seen about 20% rise in housing prices year on year. So rents haven't really caught up yet. So that starts to feed into the CPI numbers over the upcoming months.
All right. So what's your advice to investors then?
I'm sorry, come again?
No, forgive me. Anu, what's your advice then to investors who are listening, kind of your macro think on the market? So what's the strategy play for the rest of the year getting into the new year when there feels like there's still a fair amount of questions out there?
Yeah, so the outlook really remains very constructive, really across the board, medical, economic, monetary, and fiscal policy front. But for the markets, the low-hanging fruit has been picked. And as the economic cycle matures and we get into more of the mid-cycle, we just need to work harder to earn our dough. But I don't think it's really time to hunker down and hide in the bunker of safe haven assets, because the pro-cyclical trends remain well entrenched. Jobs are being created, consumer confidence remains strong, businesses are generating record profits, shareholders are being rewarded with dividends and buybacks. And these are generally positive attributes for risk assets. So really make hay while the sun shines, but on the margin, start preparing for what may come after a bright sunny day.
All right, so some good things to keep in mind. Anu, we got to run. Thank you. Anu Gagar, she is Global Investment Strategist at Commonwealth Financial Network, joining us on the phone from Waltham, Massachusetts. We do this on a day where it's definitely been a risk-off trade, although there has been a fair amount of volatility in that trade, but we're just hovering off our worst levels of the session on those major equity averages. And at the same time, we have seen some selling of treasuries, and we've seen those yields really tick up, especially when it comes to the shorter end of the yield curve. All right, it's time for our cross-platform coverage. We're heading over to Bloomberg TV and on Bloomberg Radio and on YouTube. We're counting you down to the closing bell on this Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Shanali Bassick in for Taylor Riggs, counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast team together once again. Carol Masser and Tim Stenovic in the same room at the same time. And unfortunately, it's on a day where the market's really under pressure, and a lot of this seems to be tied to that CPI report.
Well, remember when you asked me if I was buying treasuries yesterday?
Yes.
So, Romaine, I'm going to put it to you. Were you selling treasuries today? Because we really did see those yields move up.
Well, I'm just buying NFTs as an inflation hedge.
I heard that about you. All right, Tim, what are you watching?
Look, NASDAQ and Russell 2000, the underperformers today. Stocks on track to fall the most in a month. The NASDAQ right now being dragged down by the big players. Amazon, Apple, Microsoft, NVIDIA, Facebook, Alphabet, and AMD facing pressure in an inflationary environment.
Inflationary environment that isn't just in the United States. We, of course, got that PPI data in the US, so the producer side is still feeling the pain. In China, it was up 13% in terms of the factory inflation. Most in 26 years, you saw Brazilian inflation. This is a global story, but we all worry about what the Federal Reserve, the central bank of all central banks, is going to do about it.
Yeah, and you have Mary Daly of the San Francisco Fed really saying here that this is COVID. This is transitory, holding to that transitory line that we know Romaine hates.
But David Balin kind of made this point too. And look, I mean, it is, you can sort of cherry pick and go through this and find a lot of things that probably are transitory. But when you see the bump up in rental prices, when you see some of the stickiness in wages that a lot of people expect to stick around, you have to be concerned here that maybe the Fed is a little bit behind the curve.
Well, yeah, possibly. I guess we shall see. I think some would say you have to wait till we get into the next year. The one thing for sure, though, check out Bitcoin. We saw another record today, pulling back a little bit. But you were writing about it, Romaine. Is that the new inflation hedge?
I'm told it's been an inflation hedge for a while, and I mean, I joke about it here. I mean, there is certainly some hedging properties to it, of course, if you do it right. And, you know, like you can use a lot of things to hedge. You can hedge with commodities. You can hedge with gold here. Let's run through the numbers here. 240 down on the Dow Jones Industrial Average, 0.7%. S&P down 0.8%. The NASDAQ Composite down about 1.7% here. And the Russell 2000 down about 1.5% on the day here. I just, real quickly, we got a point. It's not on the board here, but we can't be remiss without mentioning yields here. A 14 basis point move higher right now on your 5-year yield, 12 basis points right now on the 10-year, your 30-year yield right now at 191.
Yeah, and let's not be remiss in mentioning when we talk about inflation hedges, gold. We've seen that move up to its highest since June, and over since like kind of the end of September, we've seen gold actually move up, Caroline, about 7%.
That's a hedge.
Here.
You know what else is a hedge? Rivian. Did you look at Rivian today?
Yeah, one of the biggest US IPOs. And tell you why it's a hedge. You also see that reflected in some of the industry groups, guys. You're seeing the gold index doing particularly well on the S&P 500 as we see that inflation hedge. Not just Rivian, Tesla actually got a bid today as well. By the end of trade, we saw Tesla up 4.3% on the day. Ford, interestingly, on the downside, considering that it has, of course, got a stake in Rivian. You're also seeing pharmaceuticals on the upside, on the downside, semis and energy gets hit as oil falls. Those supplies actually better, inventories higher than we thought in the United States.
And Rivian closed at about $100, kind of below where it opened at 106. And of course, that's still well above, of course, where it priced at 78. But the interesting thing is, I do wonder about Rivian is sort of whether this now becomes much more of that pure play EV trade. Tesla had sort of done that because by default, where else were you going to put your money if you wanted to make a broader bet on EVs?
No, that's a really good point. And is the Tesla story the one that we need to look for to understand the Rivian model? Because it's going to be a while before they are actually profitable, and then before that they are really churning out cars. Funny how you have to do that. Yeah, exactly, right?
Look, the reason you don't see these driving around the roads is because, well, there aren't any out there. The
I saw one. I saw one in New York
like
City.
300 or something like that.
Where did you see him? Where did you see him?
No, right here in Midtown.
Well, a lot of, I mean, as Ed Ludlow reported, those early models are going to Rivian employees right now.
Okay, well, I guess one of them must live in the neighborhood.
Landmark day for the IPO process, though. The 6th biggest to list on a U.S. exchange. Morgan Stanley, Goldman Sachs, J.P. Morgan, all on this IPO. Even some retail investors through SoFi getting in early. Can I say it's historic? I mean, it really is a landmark IPO.
It's pretty remarkable in terms of a new offering. It tells you something maybe about also the overall financial market or just investor interest. Over 20 underwriters, including JP Morgan, Morgan Stanley, and Goldman Sachs. The big banks all wanted to be lead underwriters on this one. So it just shows you to some of the extent of the interest, guys.
I wonder how much about the excitement when it comes to Rivian is about Amazon's involvement and Amazon's big bet. I mean, the company has invested so much money money in it, has a 20% stake, 100,000 cars on order. That's a real vote of confidence, I think, to people that says, okay, this company does have a future because it's got the backing of Amazon.
Yeah, I mean, let's be clear. We wouldn't be talking about this company in the way that we do if Amazon hadn't been attached to it so early in this process here.
Meanwhile, I mean, is it another question of collective delusion? That was some of the thoughts coming out in terms of valuations. Apollo saying that when they're over at the super return. We've got people wondering about how we can still see these sort of record numbers coming out.
Nothing's delusional in the metaverse. Everything is rational.
At least not when it comes to stocks. I mean, this Howard Marks of Oaktree, his comment about putting your money in the S&P and closing your eyes and letting it sit is still sitting with me.
Yeah, it's fascinating to hear him say that you just basically leave it, right? Don't.
That's because there's no distressed debt.
Yeah.
Yeah.
But, hey, but I mean, look, but you know, and what he says is right, but it's also something that I guess has sort of been a mantra now for decades. I mean, you go back to John Bogle, you go back to Warren Buffett. I mean, the whole idea of just sort of, you know, basically just track the market, you know, don't look, don't peek, don't try to trade in and out, and you'll
What do
do
you say?
okay.
Don't get cute.
Yeah, look, we had Suzanne Woolley on the show who spoke
It's
to...
hard for me, because...
Because you want to, right? We had Suzanne Woolley on our program earlier, and she interviewed Howard Marks, and she said, of course, one key that he keeps talking about is holding it and just not selling, because the problem that people have from a personal finance perspective is getting in and out at inopportune times. So just set it and forget it.
We'll have to question whether it's inopportune times or not to be continuing with some of the key stocks that have really outperformed, of course, throughout COVID, the stay-at-home trade. One of them was Disney, of course, did so well with some of its streaming provisions. We were going to be getting numbers out of Disney, and it's the perfect sort of encapsulation of the reopening versus stay-at-home trade, because, of course, you go into streaming. It was meant to be the buffer versus, therefore, going out there, getting to the Disney theme parks and the like. We really want to read on how well they've performed in the last few months.
Well, just take a look at the stock price over the last 6 months or so. It's been all over the chart. Talk about volatility in terms of Disney shares, and it really does play into whether we're reopening or not.
Talking of which...
Yeah, let's get to it. Disney coming out with their fourth quarter fiscal results. Revenue, let's get to that first. $18.53 billion. Folks, that is a miss. $18.78 billion is what the street was looking for. Fourth quarter adjusted EPS, 37 cents. That is a big miss. That's 12 cents light from what the street was expecting. Fourth quarter Disney Plus subscribers missing estimates. But keep in mind, Bob Chapek back at that Goldman Sachs conference back in September was saying and warning Caroline, right, investors that those subscriber numbers, that there would be, you know, maybe some concerns about that in terms of growth going forward.
Still climbing very slightly quarter on quarter. Is about 2% increase, 118 million. But the market wanted to see 119 million. Of course, we've got the issues. We're out there in LA, of course, a little while ago, guys, talking about how content has been hard to make of late. They've got that issue. They've, of course, got the focus in India that perhaps is rolling over. But revenue's still up almost 9% quarter on quarter.
Is this a cost issue, though? Because I'm looking at these numbers now, and you're talking about the parks and experiences operating income coming in at 640 million. That's well below what the street was looking for. The street was looking for 864. And similar story for media and entertainment distribution. Operating income there at 947
down
million.
53% quarter on quarter.
And the street was looking, and I don't know, I just want to make sure I have this number right, but the street looked like it was looking for something around 991. So a big miss here on some of the operating numbers that makes you wonder whether this is also a cost story as well.
Yeah, I'm going through some comments from Disney CEO Bob Chapek. He writes, quote, "This has been a very productive year for the Walt Disney Company as we've made great strides in reopening our business while taking meaningful and innovative steps in direct-to-consumer at our parks, particularly with our popular new Disney Genie and Magic Key offerings." He does say that he's extremely pleased with the success of our streaming business, 179 million total subscribers across our DTC portfolio at the end of fiscal 2021, and Shanali, 60% subscriber growth year over year for Disney Plus.
Yeah.
Still, though, shy of what analysts wanted to see.
Yeah, he's been definitely also highlighting a lot of these issues that we have over at Disney parks and theaters with reduced capacity as they still struggle through COVID-19. Guys, if you don't mind, I'd love to start getting over to Affirm a little bit too, because we have the revenue coming in for the quarter above analyst estimates after a really tough day.
Right.
Yeah, exactly. Hang on for a second, folks, because we do want to mention a little bit more on Disney. So it's down about 2.3% here in the after hours. You know, I'm looking at the parks experience and products revenue, $5.45 billion, up 26% quarter over quarter. The estimate is $5.28 billion. You know, this is such a reopening company, whether it's theaters, people going to movies, whether it's going to parks, whether it's going to cruise ships. And so if there's anything that impacts that trade and play, Romain, you're going to see some disappointment.
Yeah, and I mean, look, look, I mean, this is Walt Disney we're talking about. I mean, they're going to be okay. And I mean, but you're talking about some of the sort of pangs of coming out of this COVID crisis here. You're still talking about pretty significant growth here, 28%. And when you look at the guidance going forward, I shouldn't say guidance, excuse me, the analyst estimates, sort of what they're extrapolating, you're still talking about high teens, low 20s revenue growth here. The question then becomes sort of how do you make sure that the operating margins, Carol, fall into line with what the street is expecting?
Let's get more of a deep dive on all of that with Geetha Raghunathan, who's with us, US media analyst for Bloomberg Intelligence. Geetha, always love your expertise when it comes to breaking down these numbers. Is this a cost issue if we're seeing some of the margin operating income down so significantly quarter on quarter, even though revenue is actually increasing quarter on quarter?
Yeah, I definitely think so. So, you know, we have to also understand that it's a little bit of a one-off quarter in a way, because you have, if you look at the media and entertainment division, you're going to have all these new programming costs in terms of sporting events, which kind of came back in a big way, programming itself, new television programming, which came back in a big way. So obviously a lot of costs that, you know, kind of went in there. And then the same thing with the parks as well, you know, increased costs to kind of, you know, attract visitation and things of that sort.
Well, this raises the, well, first of all, I mean, we kind of knew this with regards to the streaming service. I mean, we saw this with Netflix. You got to spend a lot of money to sort of keep those eyeballs. The question then becomes here, how much pricing power does Disney have? I would think, given the brand name and given the legacy, they would have some of it. Why have we not seen them maybe deploy some of that weight?
So they have actually exercised a little bit of that pricing power. They did institute a price increase a little bit earlier this year for their Disney Plus service here in the US as well as in some parts of Europe. What they're trying to do now is they're trying to roll out a new brand, which is the Star brand, and along with that kind of start to increase the price, but do it in a very, very gradual fashion. So, you know, one of the greatest points, I think one of the greatest appeals of Disney was really the fact that it had a very nice low price, and they don't necessarily want to, cause more subscriber churn by, increasing prices suddenly and drastically.
You know, I'm interested in the full-year results as well, because you have operating income actually decreasing at the Disney Media and Entertainment division because of lower operating results at linear networks, sports programming as well. There was a shift here. How much of that is an issue?
So with the linear networks, the other thing that we have to kind of remember is that last year they had a whole extra week of operating results, and there's a little bit of timing and comparability issues there as well.
Geetha Raghunathan, Bloomberg Intelligence analyst for U.S. media. Let's bring into this conversation right now Lucas Shaw. He's an entertainment reporter out there on the West Coast for us. Lucas, let's start off with Disney Plus here. I mean, by all rational measures, this is still a success here, but the subscriber numbers aren't quite living up to some of the growth rates that the street was looking for.
Yeah, it's sort of the definition of whether you choose to focus on the short term or the long term, right? Disney Plus didn't deliver the growth that Wall Street wanted in the quarter, so they're unhappy about that. They're worried that means that the growth may be slowing. You zoom out a little bit, you see that Disney Plus still boosted its subscribers by, I think it's 60% year over year. I mean, they're growing faster than any other streaming service, at least in terms of the raw subscriber number. But they have now set this very high expectation for themselves going forward that's going to be hard for them to live up to, and they're going to have to talk to investors, talk to analysts to try to right-size what the expectation should be going forward, where Disney Plus is still going to be a strong and growing streaming service, but it's probably not going to grow as quickly as it did in that first 12 to 15 months.
Yeah, we should know the company still did gain 2.1 million customers for Disney Plus, but sticking with that miss because investors wanted to see 119 million, Lucas, how much of this is about content? Because I did see some jokes playing out on Twitter just in the last couple of days as people got ready for these earnings saying, Disney's content slate just leaves something to be desired because there's not every week something new that keeps people subscribing, similar to Netflix, for example.
Yeah, I think you nailed the real issue right there, which is that Disney Plus didn't release a lot of interesting shows in the quarter. Hulu actually had far more interesting projects in the past few months. Disney Plus right now lives and dies by a handful of big titles, most of them related to Star Wars or Marvel. It's The Mandalorian, it's Loki, it's WandaVision. They didn't have one of those in the quarter, I don't believe. And so when they have one of those big titles coming up, they're probably going to have a strong quarter, but they have not really filled out the catalog, other than the older movies and TV shows that people love. But they don't have a steady stream of new projects coming out every week. It's certainly not at the scale of Netflix, and really not even at the scale of HBO Max and some others.
Hey, just to rehash, Walt Disney reporting a smaller than expected increase in subscribers to its namesake streaming service. It's a sign that Disney Plus struggling to broaden its appeal after an explosive start. We do see the stock trading down 2-3% here in the after hours. We're talking with Lucas Shaw of Bloomberg News. So Lucas, how do we have to think about Disney? I think about years ago, right? We cared about ESPN Plus. That was the behemoth behind the company that was so important to top and bottom line. What is Disney? How do we need to think about it as investors, and how does this company kind of need to be positioning going forward? Where's the growth engine?
Yeah, I mean, the growth engine is undeniably streaming. The parks business is a massive business. It's one that is kind of slowly coming back to life after the slowdown during the pandemic, but is a pretty mature and stable business. The cable TV business is at best kind of stagnant or staying, if not declining. The movie business has kind of a pretty firm ceiling. It's the streaming business that has a lot of room to grow, in particular outside of the U.S. And so the question for investors, for analysts, and really for Disney executives is trying to figure out what that pace of growth is going to be. They got up to such a fast start that first day, first month, first 6 months. It made it seem like it was going to be a rocket ship for many years to come. It's still growing really quickly, but it's going to moderate faster. It's very different from what we've seen out of a company like Netflix, which had very steady growth over a long period of time. And it is going to face similar questions about its ability to sustain that, but Disney's facing those questions much faster. And the other thing to keep in mind with them is geographic. You look at the revenue that they're getting per customer, and for Disney, it continues to slide. It's now close to only $4, and that's because so many of their customers come likely from India. They've talked in the past about India accounting for between 30 and 40% of their growth.
All right, Lucas Shaw of Bloomberg News helping us break down Disney earnings. Disney shares right now down about 5% here after missing on several metrics here. We want to go down to Baltimore, Maryland, where the President of the United States is speaking about his Build Back Better plan at the Port of Baltimore. He's still being introduced there. We're going to dip in, of course, once he starts speaking here. But, of course, we've been talking all day about the supply chain issues and, more importantly, of course, about that inflation report. Look, I mean, this is a big deal. And he put out a statement pretty quickly, at least the White House did, basically saying that his administration is trying to address this. He also sort of name-dropped the Fed and said something about that the Fed also needs to do more as well.
Yeah, absolutely. But we'll continue to track, of course, Mr. Biden, the president, making some comments there from the Port of Baltimore. We'll track that and bring them to our listeners and our viewers on TV and radio. That's going to do it, though, for our market wrap. Busy day watching Disney lower in the after hours. Catch us again for Beyond the Bell on radio, on TV, on YouTube. Same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so we are watching shares of Disney now down 4.6% in the after hours. Disappointment about streaming, even though Bob Chapek has warned several months ago about, listen, there's going to be lower growth there when it comes to those subscriber numbers.
It's all about those streaming numbers. We're going to talk in just a few minutes with Tuna Amobi from CFRA. In the meantime, though, a lot of other companies reporting after the bell, and we have the latest when it comes to business news. Here's Charlie Pellet.
Thank you very much, Tim. Let us begin with Beyond Meat. It is forecasting net revenue for the fourth quarter, and its guidance has missed the average analyst estimate. After hours, Beyond Meat, they are going down now by 8%. Bumble, that is the dating app that lets women make the first move. It is raising its revenue forecast for the rest of the year and beating analyst estimates, a sign of the easing in the pandemic that is bringing new enthusiasm for matchmaking. Shares after hours down, though, by 3.1%. Disney, the focus of everybody's attention after the bell. Fourth quarter Disney Plus subscribers missed analyst estimates. And that's a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Let's take you to the Port of Baltimore. That's where President Biden is making some comments.
The port, they did work in the Bay and along here. So, this has been this one of the oldest ports in the country. continuously running and one of the best ports in the country. And so, Tony, thanks for that introduction. And Mayor Scott, thanks for the passport into the city. Appreciate it very much. And I want to thank Governor Hogan for being here and members of the delegation. I want to start off with one of my best buddies, and I think one of the most effective people in the United States Senate, Chris Van Hollen. You need something, go to him, man. He knows how to get it done. And also Dutch Ruppersberger and a guy who I knew him when he was a kid. He doesn't remember me. I'm getting so old. Knew his dad, Senator Sarbanes, and Congressman Sarbanes, Congressman Brown, and all this delegation. You got a first-rate delegation. And so I want to thank him for being here today and thank him for all the help in getting the members of the House and getting the legislation passed. It's a big deal. It's going to make a big difference. The reason I started calling this Build Back Better is we're the only country in the world. We underestimate ourselves. We're sort of down on ourselves the last 10 years or so. We're the only country in the world, as a matter of history, that every crisis we've faced, we've come out better on the other side. We not only beat it, not a joke, think about it. We've come out better than we were before we went into the crisis. And the economic and political, as well as health crisis we found with COVID, I was determined when we got elected, we got to build it back better than it was. Because the world's changing so rapidly, man. We got to keep up. We're in competition to determine whether or not we can still remain the most powerful economic force in the world. And today I'm here to talk about one of the most pressing economic concerns of the American people, and it's real. And that is getting prices down, number one. Number two, making sure our stores are fully stocked. And number three, getting a lot of people back to work while tracking and tackling these two above challenges I mentioned. Today's economic report showing unemployment continued to fall, but consumer prices remain too high. Tell us, the American people, in the midst of this economic crisis, the recovery is showing strong results, but not to them. They're still looking out there. Everything from a gallon of gas to a loaf of bread costs more, and it's worrisome, even though wages are going up. We still face challenges, and we have to tackle them. We have to tackle them head on. And on the good side, we're seeing the highest growth rate in decades, the fastest decrease in unemployment at this point ever since 1950. Jobs are up, wages are up, values are up, and savings are up. But we got problems too. Many people remain unsettled about the economy, and we all know why. They see higher prices. They go to the store online, or they can't, or they go to the store or go online, and they can't find what they always want and when they want it. And we're tracking these issues and trying to figure out how to tackle them head on. My administration, with the help of the folks on my left over here, has a plan to finish the job of getting us back to normal from the pandemic and having a stronger economy than we ever had before. Let me explain the part that the ports play, why they're so critically important. It starts with a piece of good news. Infrastructure Week has finally arrived. How many times you hear over the last 5 years, Infrastructure Week is coming? Anyway, but last week we took a monumental step forward as a nation. And we did something long overdue, long talked about in Washington, but almost never actually done. The House of Representatives passed my bipartisan infrastructure bill. Along with other plans that I'm advancing, this bill is going to reduce the cost of goods to consumers, businesses, and get people back to work, helping us build an economy from the bottom up and the middle out, where everybody's better off. You know, I'm tired of this trickle-down economy stuff. I come from Delaware, just across the line up here, and, we have more corporations in Delaware than every other nation in the state combined. And so I understand big business. The fact of the matter is, it's time they start paying their fair share. The fact is, you had 55 corporations last year that, in fact, made $40 billion, didn't pay a single penny in taxes. Nobody's gonna pay more. If you make less than 400 grand, you're not gonna pay anything more in taxes at all, period. Guaranteed, including gasoline tax, not gonna additional from a federal government standpoint. And so look, this is a once in a generation investment to create good paying jobs. modernize infrastructure, turn the climate crisis into an opportunity. When I talk climate to other world leaders, I say, think one thing. We're dealing with climate, think jobs, good jobs, because that's how you beat the climate crisis. Put us on a path to win the economic competition of the 21st century. We face with China and the rest of the world. China's outspending us on research and development. China is outspending these other countries are as well. And here's what I'm going to do. I'm going to create good-paying union jobs. Union, not good job, not $12 an hour, not $15 an hour, $45 an hour and up with good benefits, so you can raise a family on and build the middle class out. And jobs that cannot be outsourced. You can't outsource these jobs. And I'm going to transform our transportation system with the most significant investment in passenger rail in the past 50 years. In roads and bridges, the most significant investment in 70 years. And investments in public transit we've done over the period. It's going to modernize our ports with $17 billion in investment. $17 billion in investment. We're going to reduce congestion. We're going to address repair and maintenance backlogs, deploy state-of-the-art technologies, and make our ports cleaner and more efficient. And we're going to do the same with our airports and freight rail. We're going to create jobs replacing lead water pipes that are here in Maryland as well as every other state in the union that are poisoning our kids and others. We're going to make high-speed internet affordable and available to everywhere in America. Those of you who have kids in school, when we've been going this hybrid thing, some in class, some out of class, how many times, if you don't live in an area where you have high-speed internet you can afford, how many times you've driven your kids to the parking lot of McDonald's and sat there going off the McDonald's internet so you could hear? No, I'm not joking. Think of this, the United States of America, for God's sake. So, folks, we're going to build the first ever national network of electric vehicle charging stations all across the country. IBW is going to put in 500,000 charging stations across the country. And guess what? That's in the Recovery Act. That's in the Build Back Better bill, which is not going to raise taxes 1 single cent. It's totally paid for by making taxes work for people who make over 400 grand and just do their fair share. I'm a capitalist, man. You should be able to be a millionaire or billionaire if you can, but pay your fair share. Pay something along the line. I'm going to get America off the sidelines on manufacturing. The manufacturing of solar panels, wind turbines, batteries to store energy and power the electric vehicles, from school buses to automobiles. We're also going to make historic investments in environmental cleanup and remediation, rebuilding resilience against superstorms and droughts and wildfires and hurricanes. I traveled all over the country this year. There's $99 billion in losses because of storms this year. $99 billion. You ever think you'd hear somebody stand up and say the Colorado River is being drained? You ever think you'd go out, more wildfires in the West than the entire, land lost, homes lost, to burn to the ground. I've flown over in Marine One, than the entire state of New Jersey, from the Cape all the way to New York. That's how much we've lost in America. So far. And according to the economic experts, this bill is going to ease inflationary pressures, lowering the cost of working families. 17 Nobel laureates in economics wrote a letter to me about 10 days ago saying this is going to bring inflation down, not up. But best of all, the vast majority of these jobs we're going to create don't require a college degree. Don't require it. This is the ultimate blue-collar blueprint to rebuild America. I'm not waiting to sign a bill to start improving the flow of goods from ships to shelves. Yesterday, I announced a port plan of action. It lays out concrete steps for my administration to take over the next 3 months to invest in our ports and to relieve bottlenecks. This builds on the progress we've already made. Last month, I reached a deal with 2 of the largest ports in America, the Port of Los Angeles and Long Beach. And I met with you guys, with the longshoremen there, and we worked out a deal between the port owners and the longshoremen. To move toward operating those two ports, okay, 40% of everything in the Pacific comes through those two ports. And they're lined up, ships are lined up, 70-some lined up out as far as you can see. So they all agreed. We're going to go 24 hours a day, 7 days a week. It's already paying off. Last week, the number of container ships in the docks for more than 9 days fell by over 20%. And now we're announcing steps to improve ports in the East Coast, to provide support for the Port of Savannah, the fourth largest container port in the country, to help reduce congestion. With our help, they now have the funds they need to set up 5 new inland port sites in Georgia and North Carolina so goods can get closer to their final destination more quickly. And other ports across the country will have the resources they need to make these kinds of immediate investments as well. The challenge we need to meet here, and my plan is going to help address, has to do with the supply chain. You hear a lot about the supply chains in the news, but frankly, not a lot of people have a clear understanding whether they have a PhD or they didn't go to school about how a supply chain works. It says easy to talk about it, but what's the impact on the economy, let alone how to fix it? It's perfectly understandable because supply chains are incredibly complex. As long as goods and materials are getting where they need to go on time, there's usually no need to worry about the supply chains. But when global disruptions hit, like a pandemic, they can hit supply chains particularly hard. COVID-19 has stretched global supply chains like never before. And suddenly, when you go to order a pair of sneakers or a bicycle or Christmas presents for the family, you're met with higher prices and long delays, or they say they just don't have any at all. The reason for that last year has a lot to do with most companies how they make their products today. In simple terms, supply chain is just the journey that a product takes to get to your doorstep. Raw materials, plus labor, assembly, shipping, everything it takes to create the finished product. These supply chains are complex. Even products as simple as a pencil can have to use the wood from Brazil, graphite from India, before it comes together at a factory in the United States to get a pencil. Sounds silly, but that's literally how it happens. So if all of a sudden you got COVID crisis in Brazil, you can't get the product maybe because the plant shuts down. That's what's happening. Products like smartphones often bring together parts from France, Italy, chips from the Netherlands, touchscreens from New York State, camera components from Japan, a supply chain that crosses dozens of countries. That's just the nature of the modern economy, the world economy. The global supply chains have helped dramatically bring down price we pay for things we buy. But they also made us much more reliant on what happens in other parts of the world. So if a factory in Malaysia shuts down due to a COVID outbreak, which they have, it causes a ripple effect that can slow down auto manufacturing in Detroit. Why? They can't get the computer chips they need. It's a climate disaster to close the port in China. It can delay shipment of furniture or clothing, reduce worldwide supply, and driving up prices here in America. And the irony is people have more money now because of the first major piece of legislation I passed. You all got checks for $1,400. You got checks for a whole range of things. If you're a mom and you have kids under the age of 7, you're getting $300 a month. And if it's over 7 to 17, you're getting $360 a month, like wealthy people used to do when they get back tax returns. It changed people's lives. But what happens if there's nothing to buy, you got more money, you compete for getting it there, it creates a real problem. So on the one hand, we're facing new disruptions to our supplies. At the same time, we're also experiencing higher demand for goods because wages are up, as well as people have money in the bank. And because of the strength of our economic recovery, American families have been able to buy more products. But guess what? They're not going out to dinner and lunch and going to local bars because of COVID. So what are they doing? They're staying home, they're ordering online, and they're buying product. Well, with more people with money buying product and less product to buy, what happens? The supply chain's the reason. And the answer is you guys. I'll get to that in a minute. But what happens? Prices go up. So we got nearly 20% more goods coming into the country than we did before the pandemic struck. In 19 days, COVID-19 has changed the way we spend our time and our money. More products are being delivered than ever before. That's because people have a little more breathing room than they did last year, and that's a good thing. But it also means we got higher demand for goods at the same time we're facing disruptions in the supplies to make those goods. This is a recipe for delays and for higher prices, and people are feeling it. They're feeling it. So everything you've been paying this much for a gallon of gas? In some parts of California, they're paying $4.50 a gallon. That's why it's so important that we do everything in our power to stabilize the supply chain. And here's the good news. Yesterday, I spoke with the CEOs, personally spoke with the CEOs of the major retailers, Walmart, Target, and the leading freight movers, FedEx and UPS. They assured me that the shelves will be stocked in stores this holiday because they signed on a 24/7 as well. They signed on a 24/7. And they provide more avenues. They're getting more of their containers off the ports quicker than ever before. Because a lot of stuff on the ports that was sitting around, staying there. Why? Because it no longer was the product they need at this moment. And it doesn't cost them anything to leave them sitting at the port rather than their warehouses. That's moving as well. Part of the reason why is because my port envoy, John Picari, who was Secretary of Transportation here for 2 governors, deal, it's only going to accelerate. You've heard me say it before. Infrastructure used to be rated in the United States as the best in the world when I got to the Congress. But today, according to the World Economic Forum, you know where we rank in infrastructure? 13th in the world. 12 countries in the world have more modern, efficient infrastructures than the United States of America. By investing in our roads, our bridges, our ports, and so much else, this bill is going to make it easy for companies to get goods to market more quickly. Here in Baltimore, you've got a port that's older than America itself, and it's been operating for 315 years. By the way, got any Marines here? Any former Marines? Raise your hand. Well, if you're here as a Marine, happy birthday. It's your 247th birthday of the United States Marine Corps. They deserve some applause. Look, this port is connected to the nation's oldest rail line, the B&O Railroad, which in turn relies on the tunnels that are about 126 years old, those tunnels, okay? The tunnel has become a major bottleneck to the port. Now, the Port of Baltimore will be getting a $125 million grant to upgrade that tunnel. So freight trains can come double stacked through that tunnel. Double stacked with these cars, with containers on top. Twice as much. They move out a hell of a lot more quickly if they're imports going out, but if they're exports going across the ocean. That means in addition to more good jobs being filled, more products on shelves, delivery faster and lower prices, it's about taking a long-term view of our economy to deliver lower cost, more jobs, and ensure our shelves are stocked with product. And the longer-term view means building greater resilience to withstand both the shocks and disruptions that we can anticipate as the world continues to change. Pandemics, weather extremes, cyber attacks, whatever else comes our way, and they're all going to come our way. You know it. We need to be ready. We need companies throughout the supply chain to create and support good-paying jobs for people that they can grow in, build skills in, join a union, make a decent living. That's when disruption hits. So when disruption hits, companies can quickly adapt because they're invested in their workers, their skills, their training, and a strong foundation of what I always think of unions with my family. I think of dignity and respect. That's what it's about, dignity and respect. Taking a longer-term view also means making Buy American, not just a promise, but an ironclad reality. When I got elected, I said, I get to spend, quote unquote, $600 billion of your money, making everything from aircraft carriers to balloons. But guess what? So much of it has been going out and getting foreign contractors to do it. Well, this administration has been doing, we set a new rules to strengthen our domestic supply chains with new Made in America office within the White House, Never again should our country be left unable to produce critical goods because we don't have access to the materials we need. Never again should we have to rely on one company or one country, particularly when the country doesn't share our values. I've said it before, we're in a competition for the 21st century. Who's going to own it? America still has the most productive workers in the world and the most innovative minds in the world. That's not hyperbole, that's a fact. But other countries are closing in. We risk losing our edge if we don't step up now. This bipartisan infrastructure bill is a major step forward. Represents the biggest investment in ports in American history. And for American families, it means products moving faster and less expensively from factory floor through the supply chain to your home. The bottom line is this. With the bill we passed last week and the steps we're taking to reduce bottlenecks at home and abroad, we're set to make significant progress. We're already in the midst of historic economic recovery. And thanks to those steps we're taking, very soon we're going to see the supply chain start catching up with demand. So, not only will we see more record-breaking job growth, we'll see lower prices, faster deliveries as well. This work is going to be critical as we implement the infrastructure bill and as we continue to build the economy from the bottom up and the middle out by passing the Build Back Better plan. We need to unlock the full might and dynamism of our economy, guys, and of our people. I really mean it. And with this plan, we've set in motion that's what's exactly we're going to do. We're going to build a better America, not a joke. We're going to lead the world again, not a joke. We're going to be in a position where we'll once again own the 21st century. Because when we own it, everybody does better. Everybody, not only America, but around the world. Sorry to take so long. The sun's down. You don't have any sweater on. You're going to freeze. I'm going to stop talking. A man with as little hair as mine just took his hat off. I put it back on. You're going to get cold if I don't step down. But look, all kidding aside, I want to particularly thank the longshoremen. You guys, as an old expression up in Claymont, Delaware, I was from, you all brought me to the dance, man. You've stuck with me from the first time I ran. And you've stepped up every time you've been asked. Every time you've been asked. And I want to personally thank you while I'm standing in front of you. God bless you all, and God bless all the workers to keep our economy going. And may God protect our troops. Thank you so very much. Thank you.
And you've been listening to President Biden visiting the Port of Baltimore today. He has been on the road and at the port, as you just heard, to promote the $550 billion infrastructure legislation that Congress cleared just last week. $17 billion of that, Tim, by the way, would go to ports specifically. So hitting the road, talking about the importance of infrastructure and really trying to sell this to the American public before it finally gets through all of Congress and he's able to sign it off.
Yeah, it's a tough sale, especially in the wake of higher than expected inflation data, and something that politically I think puts Democrats in a really tough spot just a year out of midterms. The idea that if constituents are paying more for goods and services indeed as well, then that puts them in a tricky spot.
Yeah, absolutely. So again, talking about infrastructure and spending. All right, we're tracking that. We're also tracking shares of Disney, still lower in the aftermarket, down about 3.3%. Fourth quarter streaming signups, they were a miss in terms of estimate sales. EPS also below analyst projections. So we've seen that pressure on the share price here. And pandemic effects lingering on Disney's production pipeline. We heard that in the results. Let's get to it. And we have a great person who knows this company so well. Tuna Amobi, media analyst at CFRA Research. As I said, knows the company inside and out. Back with us and on the phone in New Jersey. Tuna, good to have you here. Thanks for your patience. It's been a little bit of a crazy afternoon. Stocks down in the aftermarket. Bob Chapek, the CEO of Disney, warned about streaming signups and that it would slow in terms of growth. So why are we all disappointed?
Indeed, Carol, good afternoon, and it's always great to be on. No, I think that, the street was actually coming into this quarter, had really tempered expectations based on the comments by Bob Chapek. But I would also infer that those expectations were a little bit higher than the number the company actually reported. I mean, it said single-digit millions. But what we see is that a major slowdown at Disney Plus. Granted, we know the reason that they already talked about, the supply chain issues for content. the India Premier, the Cricket League that was pulled off the schedule, and also the Latin America launch of Star Plus. All of those factors actually make sense to us. What we expect is a rebound in this December quarter as they launch other international markets. And I might add, Carol, the bright spot in that direct-to-consumer ESPN Plus, adding 2.2 million. I would argue that's above street expectations. So net, the revenue miss was 1%. I wouldn't get hung up too much on the EPS miss. We know that, with the return of sports and they're spending heavily now in production, but all of that I expect will begin to normalize. And let's not forget the theme parks as well, which was really, I would say, somewhat of a bright spot in this quarter.
Yeah, it's funny that you say that because Tim and I were kind of going through the press release and digging deeper and deeper into the balance sheet to really understand, subscriber growth or lack thereof among the different Disney properties.
Well, speaking of that, Tuna, Disney Plus saw 60% year-over-year growth. ESPN Plus saw 66%. Hulu's SVOD only was 22% higher. Total for Hulu was 20% higher compared with a year ago. Help us out, though, when it comes to average revenue per paid subscriber, because that was down for Disney Plus 9%. So coming in at $4.12. Help us contextualize that number and how important that number is.
Yeah, we know that number has been skewed somewhat by the Disney Hotstar subscribers, of which about 40% of the mix is attributable to that. And within that market, as I just mentioned, they had some roll-offs of subscribers, mainly due to the cricket. I mean, cricket is huge in that area. So when you have that large of a base, that's accounting for your overall ARPU, pressuring the ARPU overall. U.S. ARPU, we know it's much higher than that. So those are the kinds of ebbs and flows that we've come to expect. But net, I think they are coming off some really decent price increases, and indications are that those are been relatively well received. They've got, as you probably know, a $1.99 offer out there. They just launched a few days ago, promotional. So we'll see the uptake on that and what impact that makes. But in the near term, those also could have an impact on the overall ARPU. But the primary focus should be, subscriber growth, rightly so, as we kind of circle back to the December quarter when all the content really pipeline gets back on stream.
Hey, so Tuna, you've got a $220 share, 12-month price target on it. You've got a buy recommendation, as does most of the street when it comes to Disney. Anything in here that's going to make you come out tomorrow and say, I got to rethink this in terms of my target and my outlook?
The one thing is if the company were to all of a sudden backtrack significantly on their long-term target for Disney Plus, which at the midpoint is about $245 million by the end of fiscal 24. I mean, obviously, all eyes on that number. But I would think that they've got 3 years to double, essentially, Disney Plus subscriber growth from where they are today to hit that midpoint, which it took them 2 years to get to this point. So, granted, it's a very seasonal business, and Bob Chapek made the point it's not going to be a linear, trajectory. Right. So that number, to your question, Carol, is something that I would expect them essentially to reaffirm. But I think it's looking a little bit more aggressive, but I still expect them to hit that number.
Okay.
Hey, Tuna, just 30 seconds. What's the question you'd ask Bob Chapek or management on the earnings call?
The main question is, obviously, theme parks gets lost in the mix. So in terms of the margin expectations for theme parks, and that's still a cash cow, when are they going to get back to the peak attendance levels and the margins? That's obviously going to be a major factor as you kind of think about the recovery.
Well, and on that front, I'm looking at our live blog. Most Disneyland annual pass holders purchasing the top 2 tiers, so going for the top. Tuna Moby, we love you. You are media analyst at CFRA Research on the phone from New Jersey, breaking down Disney, which is still down in the after hours, down about 2.6%, but certainly off its lows of the aftermarket session.
And if you want more Tuna, check out Bloomberg Technology.
I always want more Tuna.
If you want more Tuna, check out Bloomberg Technology
love tuna?
at the top of the hour. He's going to be on there with our crew from San Francisco.
I was also thinking about hungry.
Fair.
I always want more tuna. You are listening to Bloomberg Business Week. A lot of earnings after the market closed. Disney, we mentioned it, but Beyond Meat also tumbling here in the after hours. Charlie Pellet.
Indeed. Let us begin with Beyond Meat, plunging now by 17%. That, of course, is the maker of plant-based burgers, sausage, and chicken. It is falling after projecting slowing sales in the fourth quarter. Bumble also reporting after hours. Shares now lower by 9%. Bumble is the dating app that lets women make the first move. It has raised its revenue forecast for the rest of the year. It did beat analyst estimates, a sign of easing of the pandemic. How it has brought new enthusiasm for matchmaking. Shares of Bumble down now by 9% after hours. Again, recapping and repeating on the Walt Disney Company, it did report a smaller than expected increase in subscribers to its namesake streaming service, a sign that Disney Plus is struggling to broaden its appeal after an explosive start. Disney Plus shares after hours down by 2.9%. Big first day of trading.
Infrastructure spending, it all plays into a bigger, broader story, Tim, when it comes to supply chains.
How much consumers are paying for goods and services. We learned earlier today they're paying at a higher rate than they have been for the past 30 years as a result of inflation picking up.
Yeah, that CPI report certainly weighing down the financial markets today and sending yields higher. So let's get to someone who has been watching some of the supply chain challenges out there, also rising food costs, especially when it comes to the restaurant industry. Michael Schatzberg is co-founder, managing partner of the investment advisory company Branded Strategic Hospitality, also managing director for Branded Restaurants. He joins us on the phone from Vegas. Michael, nice to have you here with Tim and myself. How are you?
I'm great. Thanks for having me. Really appreciate the time.
So tell us where you are, because there's actually an event going on, correct?
Yes, we are in Las Vegas, just finishing up actually two events. We're finishing up the RFDC, which is the Restaurant Finance Development Conference, which is loaded with 3,000 of the top franchise owners and operators in the country from some of the biggest brands that everyone's familiar with. And moving that right into the second conference, which starts today, is Food on Demand, which is, again, talking about delivery, takeout, and all things, again, on these large chain restaurant operations.
Hey, just very quickly before we get to that, does it feel like it's pre-pandemic? Does it feel like...
at a conference?
Yeah, you're at a conference. Does it feel like things are back to normal?
Great question. I got to tell you something. It feels like the numbers I'm hearing from the folks running these shows, in 2019, they had about 3,000 attendees. And I'm happy to report today that I just heard that there were about 2,950 attendees at this show. And the Food on Demand, which is in its fifth year, I believe, about 900 folks from the industry are here.
So a lot of people showing up. So does the people showing up kind of match with the conversations that are happening? In other words, is everybody all in and seeing growth opportunities and the economy getting back to normal? What are the conversations? What's the outlook that you're kind of culling from all of the people that are there?
Yeah, I think the outlook right now is very upbeat. I would say, like a lot of people have been talking about the roaring 20s. That's certainly what a lot of the operators are feeling right now.
Wow.
The only headwind I would say is some of the things that I heard you talking a little bit about earlier in the show was, yes, we are seeing a lot of pricing pressures, and we're seeing some supply issues. We are having to re-engineer some menus and change some things around to deal with some of these headwinds that are coming. So on one hand, we've got the consumers that are really excited about going out and spending money again, traveling, which is great. Vegas is jumping right now. The restaurants, I was out last night, were really packed. So it's great to see. But there is some pricing pressures. There's some supply issues. And, of course, there's some definite labor issues.
Okay. Let's start with supply issues. Give us some examples of what you're having to pay more for now and how much more you're having to pay.
How long you got? Really, at this point, it's everything from produce, tomatoes, lettuce, all those things, to all of our proteins, chicken, steak, fish, everything. We're seeing, really low double-digit increases across the board. We're having supply chain issues with a lot of products too. But yeah, just to your point about pricing pressures, we're seeing it across the board, which is really, on a food cost basis, we're seeing like 4 or 5% increase in our food cost overall.
What's the interest in protein-based or plant-based, items? I'm asking because we're watching Beyond Meat, which has sold off big time in the after hours. They're talking about slower sales seen persisting this year. So whether it's burgers, sausage, and chicken, and I'm just looking to see if they say why. But I'm curious about the industry's interest in plant-based proteins.
Yeah, no, it's a great question. I think I don't know enough about this specific sell-off that you're talking about, but I would think that the interest is super, super high. People are really into it. I think there may be an issue of just competition. I think there's a lot more competitors now doing the protein-based chickens and meats. I think it's probably more that than lack of interest. I think customers across the board are loving this.
Yeah, Beyond Meat down 21%.
Well, they're saying they're attributing the weakness to factors such as transportation costs, that we get that, higher inventory write-offs during the pandemic, and elevated warehousing costs.
And
so
I should say the 21%
higher.
includes today's decline as well, after hours down by 18.
Yeah, so a big thing. When we think about the restaurant industry, and Michael, to be fair, we've talked with a lot of members of the industries, investors, people who run restaurants over the last 18 months because of the pandemic. How whittled down has this industry become, though, because of the pandemic? How much have we lost in terms of capacity? And just got about 40 seconds, and then we'll come back and chat some more. Oh, actually, we're going to wrap up. Sorry.
Time flies.
Time flies.
Oh, okay. Well, yeah, this was great. Thank you so much. Should I be answering that, or is it?
Well, just quickly, got about 30 seconds. Yeah, I mean, how much of capacity has been taken out of the industry?
I got to be honest with you. I think that some of the restaurant groups that hadn't been doing well pre-pandemic, they definitely felt it the worst, and a lot of them did close. I think the companies that were doing well continue to do well. So I think that what we're seeing right now is great opportunities to open up more stores. I think the ghost and virtual space is really growing quick. Off-premise continues to be driving. So I think there's a lot of really exciting things, and we could probably talk about it on another show. But the industry is rocking and rolling. People are excited to be out and traveling. And eating out. So we're excited.
Well, look forward to touching base again. Be well and stay safe in Vegas. Michael Schatzberg, co-founder and managing partner at Branded Strategic Hospitality. For Tim Stanovic, I'm Carol Massar, the whole Bloomberg Business Week team. Have a good evening.